The financial establishment is about to erase its biggest winner for playing the game too well. Michael Saylor just executed the most brilliant financial maneuver of this decade. And the system's response isn't applause, it's a deletion order. We're talking about a treasure trove valued at over $54 billion. Not millions, billions. In Bitcoin secured on a corporate balance sheet. Saylor's firm, MicroStrategy, now safeguards nearly 650,000 Bitcoin. That makes it the single largest corporate treasury of crypto anywhere in the world. Let that sink in. A business software company, virtually unknown a few years back, now possesses more digital gold than some national governments. But the real shocker is how he pulled this off. He didn't just throw cash at Bitcoin hoping for a lucky break. He transformed a dull enterprise software vendor into what market experts now describe as a backdoor for Wall Street. MicroStrategy became the golden ticket big institutions were searching for. A method to gain crypto profits through the regular stock market without ever touching a digital wallet. The outcome? Their stock performance has utterly shattered the market averages. While the S&P 500 and even AI giants posted solid gains, MicroStrategy's shares went vertical. Investors who were barred from buying crypto directly could simply purchase MSTR stock and catch the digital currency wave with the safety of a NASDAQ listing. Pension funds, hedge funds, and traditional asset managers all rushed in. Saylor had discovered the hidden passage in the financial labyrinth. You would assume the financial elite would cheer this kind of genius, correct? A visionary who identified the next wave of digital money before his peers, strategically positioned his firm, and generated staggering returns for investors. That's the American ideal, isn't it? Take a huge risk, perform perfectly, and reap the rewards. But here's the twist that ought to alarm every single investor. The committee that oversees the NASDAQ 100 doesn't view Michael Saylor as a pioneer. They see him as a violation. According to their official guidelines, MicroStrategy has done the unthinkable in modern finance. By betting the company on Bitcoin, holding more than half its assets in one single investment, Saylor violated their core principle of diversification. Consider the sheer irony for a moment. The man makes the play of a lifetime, creates a generation of Bitcoin-rich shareholders, and outpaces nearly every other American corporation. His reward? The index gatekeepers are preparing to mark his company as hazardous and remove it from their elite group. To them, this isn't a victory to emulate. It's a dangerous single-asset gamble that jeopardizes their orderly system. The penalty is imminent, and it's severe. Financial powers don't gently show you the door when you challenge their norms. They expunge you. And when you are erased from a major index like the NASDAQ 100, the fallout radiates across the global financial system in ways most regular people never anticipate. What's coming for Michael Saylor isn't just about one firm or a controversial wager on digital assets. This reveals the true mechanics of modern markets when someone succeeds too loudly using a tactic the old guard never sanctioned. Because when you monopolize the future of currency itself, you're not competing with other traders anymore. You're challenging the entire traditional banking network that needs to dictate what comes next. And they've just flipped the emergency stop switch. There's a specific date highlighted in red on every major trading desk's calendar right now, January 15th, 2026. That's when the NASDAQ 100 rebalancing group convenes to decide which firms remain in the index and which get removed. For most corporations, this is mundane paperwork that occurs behind the scenes. But for MicroStrategy, this isn't just another meeting. This is the instant a seemingly minor regulation shift becomes a possible financial meltdown capable of erasing billions in wealth in a single day. Here's what most everyday investors completely miss about how today's markets truly function. When a stock gets removed from a major index, it doesn't just mean the company loses a badge of honor. It sets off a mandatory, unavoidable, forced selling process that echoes across the entire economic landscape with robotic accuracy. Let me break down how this mechanism works, because this is where the situation becomes truly alarming. Trillions in passive investment vehicles and exchange-traded funds are programmed to copy the NASDAQ 100 index exactly. The most famous one you likely know is the QQQ, which controls more than $200 billion. These funds do have managers making conscious choices about which stocks to hold or discard based on company health. They are essentially automated systems following one command: own precisely what the index contains. So what occurs the second MicroStrategy gets formally ejected from the NASDAQ 100? Every one of these passive funds gets an automatic instruction to liquidate the stock immediately. This isn't a slow strategic exit where savvy traders carefully offload positions to limit damage. This is institutional algorithms executing market sell orders with zero concern for share price, market depth, or trading environment. Think about what you do when you place a market sell order through your broker. You're basically telling the platform, sell my holdings now for the best available price. When you're selling a few hundred shares, that's manageable. The market handles it. But when you read discussing passive funds that together need to dump hundreds of millions of shares in a short window, that's when things become disastrous. Analysts from firms like JP Morgan have been alerting their big clients about this exact situation in private briefings. They're calling it a liquidity vacuum. And here's why that phrase should scare anyone holding MicroStrategy stock or Bitcoin itself. Right now, the main purchasers of MSTR shares are these enormous index funds that are obligated to own the stock because it's in the NASDAQ 100. But the moment the deletion is official, these compulsory buyers disappear from the market immediately. Imagine you're trying to sell your car, but suddenly every dealership in the nation is legally forbidden from purchasing vehicles. That's not a scenario where you haggle for a small discount. That's a scenario where you may not find any buyer at any price. The market doesn't just dip, it evaporates completely. Now, here's where Michael Saylor's kingdom becomes incredibly fragile. Remember, he didn't assemble this $54 billion Bitcoin hoard just using company cash reserves. Saylor employed one of the most bold corporate financing strategies in recent memory. He issued convertible bonds, essentially loans from big investors who agreed to provide capital in exchange for the right to convert those debts into MicroStrategy stock at set prices. According to public filings, MicroStrategy has billions outstanding in these convertible notes with various end dates and conversion levels. This approach worked perfectly when the stock price was rising because the lenders were content to either receive interest or convert their loans into valuable equity. But this entire framework relies on one crucial premise, that MicroStrategy stock will always be easy to trade. The moment that premise fails, everything begins to crumble. If the forced selling from index removal causes the stock price to plummet below certain levels, some of these convertible bond deals have clauses that could permit lenders to request immediate cash repayment. And here's the doomsday scenario that haunts market experts. If several lenders all demand their money back at once, where exactly does MicroStrategy find the cash to pay them? The company's main asset is Bitcoin, which is famously unpredictable and hard to sell in enormous quantities. Saylor can't just phone an exchange and sell 50 billion in Bitcoin on a random afternoon. That scale of selling would tank the entire crypto market, which would make the stock price drop further, which might activate more debt requirements, which would force the sale of even more Bitcoin. This is what finance professionals term a death loop. Each compulsory step worsens the crisis, triggering more forced steps, which speeds up the collapse. And unlike a classic bank panic, where officials can intervene and suspend trading or offer emergency funds, there's no safety net for this event. The index regulations are the index regulations, and the passive funds will run their selling protocols no matter the outcome. What makes January 15th so particularly brutal is the schedule. We're not discussing a decision that could happen someday. This is a fixed deadline that's approaching fast. Whether Michael Saylor is prepared or not, the committee will gather. They will examine MicroStrategy's asset makeup. And if the Bitcoin stash still accounts for over 50% of the firm's assets, the removal becomes mandatory. Saylor knows this is approaching. Every major bank knows this is approaching. And yet, there's almost no move he can make to stop it without surrendering the very plan that brought him victory. He could potentially sell some Bitcoin to lower the concentration, but that would betray the entire point of his gamble and probably crash the price anyway. He could attempt to purchase other large assets to broaden the balance sheet. But what business could he acquire that's big enough to offset 54 billion in Bitcoin? The snare has been sprung. The process is already underway. And on January 15th, someone will activate what might become the biggest forced selling event in digital currency history. The only remaining question is whether Michael Saylor has a final card to play or whether the establishment is about to make an example of the man who dared to win too massively. Now, let's discuss what occurs if this death loop actually begins turning. Because once those pieces start falling, The repercussions don't end with MicroStrategy's share value or even Michael Saylor's personal wealth. This could set off a wealth eradication event that impacts every American who holds Bitcoin in their investment account. Visualize the sequence of events happening in real time. January 15th comes. The NASDAQ committee announces their verdict and MicroStrategy gets formally deleted from the index. Within hours, the passive fund algorithms start performing their coded commands. Hundreds of millions of MSTR shares hit the market with machine-like disregard for value. The stock that was trading at premium valuations due to its Bitcoin leverage suddenly becomes poisonous inventory that institutional players are desperate to discard. As the share price implodes, those convertible bond owners begin getting anxious. They're seeing their investment lose value by the second, and they start scrutinizing the details in their lending contracts. Some of these bonds have safety terms that activate when the stock price drops below specific marks. Others have conditions that allow early cash out if the company's financial health weakens. The calls start flooding into MicroStrategy's finance office. Lenders want their capital returned, and they want it immediately. Michael Saylor finds himself confronting a no-win situation. He could try to renegotiate the debt, but who will loan money to a firm whose stock is in a nosedive and whose primary asset is a volatile crypto? He could attempt to generate cash by issuing new stock, but the forced selling has already annihilated the market for his shares. Every conventional funding avenue requires either willing creditors or willing shareholders. And right now, both have vanished. That leaves just one path available. The path that Bitcoin owners globally are hoping he never has to take. Michael Saylor would be compelled to begin selling the Bitcoin itself. Now, you might be thinking, big deal? He sells some Bitcoin, settles the debts, and continues. But here's where you must grasp the immense size of what we're facing. MicroStrategy owns 649,870 Bitcoin. At current values, that's over $54 billion in cryptocurrency. But here's the vital fact about Bitcoin markets that most average investors don't get. Liquidity for such colossal sums simply does not exist. When you or I trade Bitcoin on an exchange, we're handling amounts the market can easily digest. A few thousand, maybe even a million if you're sizable. The order book has sufficient buyers and sellers at different prices that our transactions barely cause a ripple. But when you're attempting to sell billions in Bitcoin, you're not just taking liquidity from the market, you're obliterating it. Think about what happens when rumors start circulating through crypto trading forums that MicroStrategy is being forced to liquidate. Every advanced trader on Earth instantly begins shorting Bitcoin, wagering that the price is headed for a crash. Market makers withdraw their buy orders because they don't want to get crushed. Retail investors who were thinking of buying suddenly choose to wait for cheaper entry points. The mere news that Saylor might need to sell creates a vicious cycle that makes selling even more damaging. And here's the most heartbreaking part. Saylor doesn't need to sell all 650,000 Bitcoin to wreck the market. Based on crypto market research, offloading even 10 or 20% of that position quickly would swamp worldwide Bitcoin liquidity. The price wouldn't just drop steadily. It would suffer what traders name a flash crash, where automated selling triggers stop-loss orders, which triggers margin calls, which forces more selling, creating a chain reaction that can erase half of Bitcoin's worth in hours. Now, spread that impact across every American who owns digital currency. Maybe you purchased Bitcoin in a retirement account, expecting it to help fund your retirement. Maybe you allocated a part of your portfolio to crypto because experts said it was the next big thing. Maybe you were just an ordinary person who invested a few thousand into Bitcoin because you trusted the tech and wanted to be part of a new financial system. None of that matters when MicroStrategy starts selling. Your Bitcoin investments get demolished right along with the whales, the funds, and Michael Saylor himself. The collapse doesn't distinguish between early holders and new entrants, between true devotees and casual dabblers. Everyone holding Bitcoin watches their net worth dissolve as the biggest corporate owner in history unload supply into a market that can't handle it. But let's pull back and ask the question that should be on every investor's mind. How did we reach a point where one company's mandatory expulsion from an index could potentially annihilate billions in value across a whole asset class? This isn't standard market activity where buyers and sellers agree on fair prices. This is a system where bureaucratic rules made by index committees can initiate automatic forced sales that ripple through international markets with ruinous precision. And here's where the narrative takes its most sinister turn. Some market watchers are quietly discussing something that sounds almost like a conspiracy, except the evidence aligns too well to dismiss. They're naming it the bank takeover theory, and it goes like this. Traditional banking institutions have been observing the crypto revolution with increasing unease for years. Bitcoin poses an existential danger to their dominance over the economic system. Central banks can't create it. Commercial banks can't magic it into existence through lending. And payment networks can't charge fees on every transfer. If cryptocurrency actually becomes a widespread store of value and payment method, it undermines the complete business model that banks have used to generate profit for generations. But banks couldn't simply outlaw Bitcoin or regulate it into oblivion without appearing to be the very oppressive gatekeepers crypto advocates claim they are. They needed a more sophisticated solution, a method to take command of the cryptocurrency ecosystem without directly assaulting it. And Michael Saylor's aggressive buying strategy gave them the perfect opening. By permitting Saylor to dominate the market, by letting him build a huge concentrated position using leverage and convertible debt, the traditional financial system established what military planners would call a kill box. They let him walk right into the ambush, accumulating more and more Bitcoin at rising prices, funding it with debt instruments that seemed brilliant during the boom, but become fatal the instant liquidity dries up. Now, with a straightforward rule adjustment about index membership, they can initiate a forced liquidation that crashes the Bitcoin price from recent peaks back down to 40 or 50,000. And who will be standing by with billions in ready cash to purchase Bitcoin at those fire sale prices? The same major banks and financial institutions that have been quietly constructing their crypto trading desks while publicly doubting digital assets. This isn't a market correction. It's a calculated wealth transfer. Consider the colossal shift of wealth that would represent. Saylor and early Bitcoin supporters bought at lower costs and endured the swings, believing they were ahead of traditional finance. But if this forced liquidation scenario unfolds, those same traditional financial players get to buy the identical Bitcoin at huge markdowns, acquiring in months what took Saylor years to gather. They don't just profit, they profit by using Saylor's own blueprint against him, taking control of the assets he spent billions collecting while he's forced to sell at the absolute worst time. The deletion from the NASDAQ 100 isn't a penalty for breaking diversification rules. It's the trigger for one of the biggest organized wealth grabs in crypto history. And the masterstroke from the traditional banking system's viewpoint is that it all occurs automatically. No conspiracy needed, no secret agreements required, just a bureaucratic panel applying their regulations precisely as written, activating market mechanisms that function with perfect efficiency, shifting billions in Bitcoin from crypto pioneers to traditional financial giants. Michael Saylor wagered it all on Bitcoin being the future of finance. He risked his name, his company, and his investors' money on the conviction that decentralized digital currency would overtake the corrupt old financial network. And now that same old network is getting ready to use his own achievement against him, turning his crowning victory into the instrument of his possible ruin. The question for every person watching this unfold is straightforward. Are you ready for what happens when the biggest Bitcoin holder in corporate history is compelled to become its biggest seller? Because prepared or not, January 15th is arriving. The timer is already ticking. And when that date comes, we'll all discover whether Michael Saylor's Bitcoin gamble was the genius move of the century or the prelude to the most sophisticated market engineering of our time. Don't let your portfolio be blindsided. If this opened your eyes, hit the like button and follow us.